If you're using the 4% rule, you may not be spending enough in retirement. Now, I bet you didn't expect a financial planner to tell you that you're not spending enough, did you? Well, one of the criticisms of the 4% rule is that it's probably too conservative for all but the small number of retirees who retired in some of the worst economic times in U.S. history. And the process is so methodical that it goes against human behavior. In reality, few people are going to mechanically adjust for inflation every year, and they will cut back on their expenses and withdrawals when their portfolios are down. So let me invite you to consider another method for making sustainable withdrawals over your retirement. They're called Retirement Guardrails. In 2006, not satisfied with the 4% rule, a couple of dudes named Guyton and Klinger came up with a new way to think about sustainable withdrawal rates. They hypothesized that literally 0 people withdraw 4%, adjusting annually for inflation, from their retirement accounts each year. Even accountants and engineers weren't that robotic. Their theory was that if a retiree's accounts drop a certain amount, they would naturally lower their withdrawal rate. This would also help mitigate some of the over-conservatism of the 4% rule. They went back and they did the math, and here's what they came up with. Retirees can sustainably withdraw up to 5.3% of their portfolio value per year, adjusting annually for inflation. But if their total portfolio drops below a certain amount, then they have to take a pay cut. Conversely, if their portfolio grows enough, they can increase their portfolio withdrawals. Where the 4% withdrawal rate is too conservative for most retirees, moving up to a 5.3% withdrawal rate sounds like a huge pay increase. But there are rules. Here's how they work. Your first year of retirement, you start off with a 5.3% withdrawal rate. For example, if you start retirement with a $1 million portfolio, your first year's withdrawals should total $53,000. The following year, we want to see what that looks like adjusting for inflation. So if CPI was 3% the prior year, the inflation-adjusted amount for year 2 would be $53,000 times 103%, which equals $54,590. But we want to double-check our year 2 withdrawal rate. So let's say that your portfolio has grown to $1,050,000 even after your prior year withdrawals. Your year 2 withdrawal rate would now be $54,590 divided by $1,050,000, which equals 5.2%. If this new withdrawal rate is within 20% of the original withdrawal rate, you just use the number that we just calculated. In this case, you'd proceed with the $54,590 distribution for year 2. The withdrawal rate range that we want to stay within ends up being between 4.2% and 6.4%. Now, if you have bad luck and your portfolio drops in value, you might have to take a pay cut. If your new portfolio withdrawal climbs above 6.4%, you'll need to reduce your prior year's withdrawal amount by 10%. If you have good luck and your portfolio climbs in value, you get a pay raise. If your new portfolio withdrawal rate drops below 4.2%, then you increase your prior year's withdrawal amount by 10%. Finally, if your new year's portfolio withdrawal rate stays in this range, but your portfolio happens to be down that year, you just skip the inflation increase and go with the same amount that you took last year. And by the way, to make all of this easier, I've created a spreadsheet that includes this guardrail strategy as part of my Stress-Free Retirement Blueprint course. I'll post a link in the description below if you're interested. While the guardrail strategy does add a higher initial withdrawal rate, flexibility around portfolio withdrawals, and some built-in risk management for market downturns, they do have their criticisms. After laying out the rules a minute ago, you may have picked up on the first one. They're complicated. Using the guardrail strategy requires that retirees have a process and be disciplined for them to work. Not everyone has the patience and methodical mindset to pull this off. Next, it can be difficult to cut back on your spending if your portfolio is down. It's way easier to spend more than it is to spend less. And if some of your non-discretionary spending is dependent on those higher initial withdrawal rates, the guardrail strategy can lead to disaster. The next criticism of guardrails is that they still require retirees to be disciplined investors. Remember that we as humans are wired to make the exact wrong decisions at exactly the wrong moment when it comes to investing. You'll still need to have a disciplined investment process. Finally, just like all retirement planning, guardrails are not foolproof. There are no guarantees here. Some retirees who might have large unplanned withdrawals may want to opt for something a little bit more conservative. So who are guardrails for? If you are comfortable with your investment strategy during market downturns, have some flexibility in your retirement spending, have a high Monte Carlo probability of not having to adjust your lifestyle in retirement, and are disciplined and process-oriented enough to review this every year, then Retirement Guardrails may be a good option for you to consider. But they're not for everyone. Of course, I'd encourage you to consult with a fee-only financial planner if you want a second opinion, or if all of this is just too much to deal with on your own. But nailing your retirement withdrawals help in answering only one of the two most important questions in retirement planning. Curious about the other question? Click on this video to learn more. I'll see you there.